Three, two, one.
Here we go. Give you an introduction. If you guys joined our workshop a couple weeks ago, it was our first of many workshops that we're going to do from Directed IRA that is really geared to help Directed IRA clients first, find out what they really want to invest in and see what actual real self-directed IRA investors are doing with their retirement accounts. We have a lot of case studies. I've been in the business for 10 years. I've got a lot of good stories, bad stories, lessons. So I love sharing this with you guys, not in any way to tell you what you should or you shouldn't do, but just to give you an idea of, any profits, pitfalls, lessons in between that I've learned. I want to share that with you guys so that you guys are better self-directed IRA investors. As we go along too, I'm going to have different guest speakers. Today, we don't have a guest speaker that's going to have a whole segment with us, but we do have a special sponsor with us that I want to introduce to you guys. And we're going to have sponsors throughout as well. Some of these sponsors host their own educational events. Some of these sponsors might even have investment opportunities. You're never going to hear them sell anything to you though on this podcast. Or on this workshop. That's something that we are forbidden from doing, but they can at least give you an idea of what some investment opportunities might be out there or where you can find them if you're struggling to find alternative investments on your own. So I want to bring in my buddy, Nathan Turner. Nathan, are you with me?
I'm here. How are you?
Awesome. Good to see you, man. The best name in the note business, the Canadian note guy. I love it. I
thought you were going to say Nathan. That's the best name right there.
That's without being said. So he's a Nathan, I'm a Nathan. So obviously we got to get along. So, but he's got a great event that's coming up and I wanted him to kind of share that with you guys. Directed IRA is actually one of the sponsors of this event. And I've been to these events in the past. And if you are interested in kind of taking a more passive approach to investing your IRA, they have a lot of great speakers and a lot of great content that's specific to note investors. Now, it doesn't mean you have to be a note investor. That's just if you want to learn more about note investing. So, Nathan, tell us a little about the event, when it is, what can people expect, and if they want to participate, how do they participate?
Yeah, I'm really excited for this. This is the Diversified Mortgage Expo. This is the 8th annual Diversified Mortgage Expo.
I just say the DME.
The DME.
The DME.
But this is actually the first time that I'm hosting it. So I've spoken at this conference before. I've attended this conference before, but this is the first time that I'm actually hosting. So I'm really excited about that. It's been a really fun challenge putting it together and organizing and everything. Awesome. But it's 2 days all about notes. Whether you're in notes already or whether you've just heard about this and want to learn more, this is a fantastic place to come together and just learn more.
And where's it at?
This is Nashville, June
Tennessee.
2nd and 3rd.
June 2nd and 3rd. So it's right around the corner. Tickets are still available?
Yes, they are.
Okay.
I'm just looking at my calendar. We're about 2 weeks out from upping the ticket price. So if you want to take advantage of the early bird ticket price, that's available until May 5th.
Okay, awesome.
You have about 2 weeks to get that deal.
And tell them a little bit about yourself, because you've been around the note business for a long time, and we were just kind of laughing off camera. I've known Nathan Turner separately as a note investor, and I've been a part of the DME, and then just recently those two joined forces. So tell them a little bit about yourself as well.
I'm a note investor. I have been. I got started in 2008. I started creating some notes, and I was doing a lot of seller finance stuff. At the time, it was like centered in one city. We were Columbus, Ohio, and creating notes. I didn't even know that was what they were called at first, and just kind of learned as we went. I started buying non-performing notes in 2010 when there were 1 million of those.
Yeah.
And pricing was really good.
There might be more coming. You never know.
I see some coming. I don't know how many or how bad this is going to look or how good it's going to look, depending on your perspective.
But I think it's good, especially now, depending on what might happen. It might be good for people to prepare and at least understand, how to buy a non-performing note or a performing note, how that process even works. I was in the mortgage business for many years, but I wasn't in the area of buying notes. We were creating notes. So I've learned a lot from, people like yourself and people at the DME. And I've specifically been a note investor too. So I love note investing. I think if you're into real estate at all, you should understand how note investing works. And I would say the best investors that I've seen use self-directed IRAs, they actually do both. They might have some real estate assets, some cash flowing rental property owned in their IRA, and they have some notes. And that's a good diversification tool within alternative investments, I would say.
Yeah, and it's a fantastic IRA investment because it's cash flow. So you get all the benefits of the cash flow without any of the headaches. You can invest into a fund if you want to, and just be like completely passive, and it's just interest income.
And you forgot no
It's
taxes.
great. And no taxes.
That's the big.
Yeah.
That's the big part. So,
That's
thanks,
the big
Nathan.
part.
How can people register for the event? Where should they go?
So go to diversifiedmortgageexpo.com. Tickets are there under the tab that says tickets. And I hope to see everybody there. We're looking at, so just to give you an idea, we've got a whole bunch of note buyers there. We've got a whole bunch of note creators there, which is kind of a new twist that we're adding this year. We're inviting a whole bunch of seller finance people. So if you've got notes that you're looking to sell, if you want to learn more about notes and how they work and why they work, if you want to do seller financing, if you want to meet different vendors, talk to Nate while he's there, like whatever. It's just a great meeting place. So
we'll be there. And yeah, and you hit it on the head. Networking is always a good thing with these events too. So thanks, Nathan. Hey, you guys go check that out. We're going to jump into the workshop here in a second, but thank you, Nathan, for your time. And we'll see you in June in Nashville.
My pleasure. Thank you.
Okay, thanks. All right, guys. So as we jump into this, let me switch over to my presentation for a second. And I just want to remind everybody that as we go through this, if you guys have questions, just type those questions into the chat box. We've got, I'll mention we've got myself on here, but I probably won't be able to see questions as we go along. I've got Tristan here that can relay questions, but I've also got Jeff Minnick, who's our Vice President of Business Development. He's also got 10 years of self-directed IRA industry experience. So if you've got some technical questions or questions about IRAs, he's going to be on there as well. So ask your questions. Don't hold them till the end. We'll try to get to as many as we can through the thing, but then we'll get to them at the end as well. So let's just jump into this. And as I share my screen, one sec. Studies here. So just introduction real quick. My name is Nate Hare. I'm a certified IRA services professional. What's that mean? It's just a nerdy term for us that take a equivalent of a bar exam. And basically it's issued by the American Banking Association. It just means that we know a lot about IRAs, not just self-directed IRAs. I've been in the business for 10 years. Prior to that, I was actually a real estate investor and actually in the mortgage business. So I learned a lot of real estate stuff there. But I will tell you guys, ever since I got into self-direction, I've learned more about investing than I ever would have learned working my corporate job as a loan officer. I knew how financing worked on residential mortgages, but investing in self-directed IRAs has kind of opened my eyes to all these cool things and cool strategies that I like to talk to you guys about today. So you've got myself on here. You've also got Jeff Minnick, who I mentioned. He's also a certified IRA services professional. So on the program right now, you've got over 20 years of self-directed IRA experience. So, and we're going to do these consistently through the month. So you guys can ask your questions as we go along. For new people, let's just start with basics. Let's define what an IRA is and how is that different from a self-directed IRA and a real estate IRA. Okay? IRAs are no different no matter where you have them. Okay? Don't get confused with the term self-directed or even real estate or anything in front of IRA, even if it says rollover IRA. IRAs are IRAs are IRAs. An IRA stands for an individual retirement account or individual retirement arrangement. An account at Fidelity is no different than an account at directed trust company or directed IRA. But why can you invest in real estate at directed IRA, but you can't invest in real estate at Fidelity? It has nothing to do with the IRA rules. It just has to do with what the custodian of your account does as a business model. Fidelity, Charles Schwab, E-Trade, all those traditional brokers are licensed securities brokers selling investments. Doesn't make them bad guys, just understand the nature of their business. They sell stocks, bonds, mutual funds, and CDs. Okay, those are called traditional investments. When you look at the IRA rules, okay, Publication 590, if you want to nerd out and read some IRS code, but Publication 590 lists all the investment options. And if you want to dive even deeper, you can read IRC 4975. In there, you'll find that the IRS does not tell us what we're allowed to invest in when it comes to our IRA or our 401k. They only tell us what we're not allowed to invest in. And the list is really short. The only investment restrictions when it comes to an IRA or 401k or an HSA is life insurance contracts and collectibles. That's it. Those are the only two investment types that you're not allowed to hold in a retirement account. I'll repeat that: collectibles and life insurance contracts. Don't get life insurance contracts confused with life insurance. There's obviously life insurance products that you can invest in, but having insurance on someone else's life and getting paid when they die back to your IRA, that's prohibited. Okay? Also, collectibles, they don't like collectibles in an IRA because collectibles are hard to value, right? Usually the value of a collectible is what somebody would pay for it. So collectibles are specifically defined too. It's things like classic cars, antique rugs, paintings, certain gems and metals. Those are the only things that aren't allowed in an IRA, whether it's self-directed or an IRA at Fidelity. The difference comes in the account agreement with us at Directed Trust Company or Directed IRA. When you sign an account agreement with us, it says invest in anything the IRS allows, but you pick the investment. We'll sign off on the investment. We'll hold the investment in your IRA so you reap all the tax benefits, but we're not going to sell you an investment. We don't have investments to sell you. And that's the only difference. So don't get confused with self-directed or real estate. It's just marketing terms. An IRA at Directed is no different than an IRA at Fidelity. And to be honest, most of our clients have IRAs at both places. Why would you want to have IRAs at Fidelity and have IRAs at Directed? Well, then now you can invest in all the asset classes that are available to you. I'm not against stocks or bonds or mutual funds. I think those are great investments. So you should have a brokerage account with one of those big guys and have some of your investments there. But if you want to have some investments that are more tangible, investments with multiple income streams, or maybe even investments that you understand better, like real estate, well, then you need to set up an IRA with a company like Directed so that you can buy those types of investments in an IRA and still get your tax benefits. Okay. If you're not familiar with Directed IRA, we're based in Phoenix, Arizona. Our owner and founder, Matt Sorensen, wrote the #1 selling book, The Self-Directed IRA Handbook, which is used by almost every company in the industry. And we have about 12,000 clients that are actively using self-directed accounts to buy alternative investments like real estate. So we're not new kids on the block, and we're growing rapidly, probably the fastest growing self-directed IRA company in the country, I think. Okay. And just to give you an idea of what retirement looks like nowadays and why we talk about why these programs are so important for people. Because when you look at it, retirement accounts are the largest source of American wealth. More money is in retirement accounts than people's checking accounts or savings accounts. This is where most people's nest egg is. And it's wild to know that there's over $30 trillion in retirement accounts, it was close to 35 trillion at one time, hit a little speed bump in the stock market. I know the last couple of years dipped down to 33, but we're back a little bit on the rise. But there is so much money in retirement accounts. And I would make an argument that most people don't know what their retirement is invested in. Most people are just taught to work at a company, put money away in your 401k, let somebody else manage it for you. And then by the time that you're 59 and a half, you'll have enough money in there to retire. That's fine for some people, but that's working and shoveling money into your account, trying to retire on your savings because those returns might be low. Who knows? Self-directed IRAs allow you to put the keys in your hand and actually choose other types of investments. And it's important to know that because when you look at the largest bucket of money in retirement accounts now, it's no longer 401ks or 403bs. It's IRAs. IRAs make up about $14 trillion of American retirement because once you move from job to job and you have separation of service, that 401k you had at that job rolls into an IRA. So with everything been going on the last couple of decades, more people have money in IRAs now than current company 401ks. And that's important because once it's in an IRA, most likely it can be moved to a self-directed IRA and self-directed. So what are the types of alternative investments our clients typically choose? Now, I've seen all sorts of weird investments over my 10-year period, but at each company I've worked at, it's pretty much the same. A lot of clients like to invest in rental property. Okay, rental property, fix and flips, apartment buildings. A lot of people like to invest passively through notes, but most often those notes are secured by real estate. So all the investments that we typically process for our clients, they're either direct purchase of real estate using the IRA, or they're in owning real estate in a roundabout way, either by owning a note secured by real estate, or they might be invested into some syndication. Syndications are people that are grouping large sums of money to buy like an apartment building or a commercial property. So why are so many people gravitating toward real estate when they self-direct, when you can invest in all sorts of things, oil and gas? I've even seen a client buy a thoroughbred racehorse in his IRA. That's not this class, but we're going to stick to real estate. But I think for the most part, people know what to do with a piece of real estate. It's familiar to them. A 3-bedroom, 2-bath house, everybody knows what that is. How do you rent it? Get a property manager. It's not rocket science for most people to invest in things like real estate. But when you apply your retirement account to real estate, now you get all sorts of different tax advantages that you might not have thought of, and that your wealth advisor is definitely not telling you, because he's probably wanting you to invest mostly in the things that pays him, which is your stocks and your bonds and things like that. But these would be the most common alternative investments we see: rentals, notes, private equity, private stock, but the list goes on and on. Let's dive into real estate. Talk a little bit about real estate. Why do clients like real estate in an IRA? Well, one of the things that's different about real estate than stocks is real estate's tangible. Okay. It's like this desk. Okay. I can touch this desk. I can feel this desk. Real estate is an asset you can drive by, touch, and feel. Okay. It can't evaporate on you like a stock can. You invest in a stock in the wrong company, that company goes belly up or bankrupt, you're not left with anything. There's no recourse there. You're left with a useless piece of paper if that's something that you invested in. Not calling that investment bad, but it's fundamentally different with that type of asset than real estate. You buy a piece of real estate's tangible. What I mean by that is real estate can burn to the ground, but what do you have to prevent loss on that? Insurance. Why? Because insurance companies will insure tangible assets like real estate. Okay. It can go up and down in value, sure, but that's just the way that the market goes. So can your stocks. They can go up and down in value. But if you own a property cash, it's almost impossible for that asset to go to zero. Even if the house gets blown away by a tornado, you still have land. And land's about 50% of the value in some cases. So there's a big, big difference between a stock and a piece of real estate. And the reason I want to mention that is because most of our clients who own real estate are not real estate investors by trade. They just like real estate because it's tangible, and they want to have some sort of tangible assets in their overall portfolio, so they're not subject to risk owning a bunch of paper stock that could fly away in the wind. The other thing clients like to use self-directed IRAs for is just to diversify. Okay, we hit this on the head all the time, but diversification is key. Diversification is not high-risk mutual funds, medium-risk mutual funds, and low-risk mutual funds. Diversification is maybe some mutual funds, but having some alternative assets. If you guys weren't aware, it's actually pretty interesting, the shift that's has been made with alternative investments just in the past year. Just to give you an idea, alternative assets, real estate, notes, private companies, private equity, syndications, is the largest growing asset class for retirement assets over the past year. It's expected to continue to grow at least 60 to even 70% by 2035. Why is it becoming so popular now? The access to information. Okay. Technology has helped the everyday investor find investment opportunities that in the past were only subject to the people that were in the know. The wealthy have been investing in alternatives since IRAs were created in the 70s. Okay. It's not new to the wealthy. It's funny to see. There was even an article in Forbes in 2020 that out of all the IRAs that are out there, about 2%, 2 to 3% of the IRAs in existence own alternative assets. But when you just take out the IRAs that are valued above $5 million, 25% of the assets in those IRAs are alternative assets. Goes to show you, the wealthy understand the power of alternative assets. And I think now we're in an interesting time because people have access to this. And this is why we love doing this at Directed IRAs, to teach people that, hey, yeah, you can have $1 million IRA. You might need to find some different investment opportunities that might not have been sold to you or shown to you in the past. Tax savings is the big one that IRAs give us no matter where we park our IRA. An IRA is by definition a tax-exempt trust. Okay? You're the fiduciary of the trust, meaning you have to find investments and help it grow. But you get your benefit when you take distributions in retirement, hopefully. Okay? You can take distributions before then, but it's beneficial to wait until 59 and a half. But as you buy and sell investments within your IRA, the investments are not taxed, whether it's a traditional, a Roth, an HSA, an ESA, a 401k. You can buy and sell a stock and you never have to pay tax until you potentially have to pay tax when you take distributions. So all of the growth within the IRA is considered tax deferred because it's a tax exempt trust. It's the way the government says, here, we'll help you get to retirement as long as you put some money away in this trust that you manage, you invest, we won't tax you on any of the income. This is huge when you think about real estate, because real estate, you have capital gains tax. There's no capital gains tax in an IRA, 99.9% of the time. We'll talk a little bit about when there is, but 99.9% of the time, well, 100% of the time, if you're buying a property cash and you sell it, no capital gains tax. The benefit of that is if you buy and sell investments in an IRA, you can grow that bucket bigger because you don't have to pay Uncle Sam every year. So your bucket grows much faster. But we're going to talk about some case studies where clients use, which is my favorite, it's the Roth IRA. And the Roth IRA works a lot different. And we'll hold those thoughts when we get to the case study, but I'll show you the difference between owning a property in a traditional IRA versus owning a property in a Roth IRA. It's pretty interesting. The other thing that self-direction allows you to do is be a little bit more socially conscious with your investment. And I know it sounds like a cheesy thing. It's not all about dollar signs sometimes, but if you think about it, when you have control over your IRA and the investments within it, you can direct it to invest in some cool things. I'll give you a quick example. I like to do notes. Okay. We kind of mentioned that early in the program. I like real estate. I just don't have time to find it. But I run into a lot of investors like Nathan Turner and all these, or not Nathan Turner specifically, but investors that are finding property that need some money to buy property. And maybe, the banks have already given them 10 loans, who knows? But there's so many real estate investors, good real estate investors that could use some capital. And I like to be the financing component with my IRA. But the cool thing for that investment is I get to pick who I loan to. Okay. I can invest in areas that I want to see succeed. So for instance, I live in Phoenix, Arizona. Wouldn't it make sense that I invest with real estate investors in Phoenix? Because indirectly, my note investment to that investor is making my own community a better place to live and play, because I know what that investor is going to do with my money. Okay. First, I'm going to secure it with a note and a deed of trust so I can sleep at night. So I know I have some collateral, which is the house. But that investor is going to take my money and he's going to go and he's going to hire contractors. Okay. He's going to put contractors to work with my money. Contractors are going to hire subcontractors. They're all going to work on the house. They're going to get materials at Lowe's, at Home Depot. They're going to put money back into local businesses. Okay. Once the house is all done, they put up the white picket fence. And then what do? Well, the investor sells it to a family that needs a home, sell them the American dream, maybe rent it to a family, lease option, who knows? But ultimately, with that investment, that single investment I do as a loan to a real estate investor out of my self-directed IRA, makes my community a better place to live and play. And when we improve the value of that home with my money and his sweat equity, it improves the value of the other homes in the neighborhood. If everybody thought about their retirement in those regards, think how beautiful our communities would be. And that's what you can really do with the self-directed IRA. So yeah, the tax savings is cool. Diversification is cool. It's tangible assets. That's cool. But also the social implications are pretty cool too. So I'll get off my soapbox for now, but you can invest in all those things, but you can invest in what you understand. And that if you understand real estate better than you understand the stock market, I would say, try your hand investing your IRA into real estate instead of stocks. Let's go over the accounts real quick, and then we'll get to some case studies. Most people have what's on the left side, which is your personal plans. Most people don't even talk about the other plans that we have here. We actually have 7 different types of plans that all have different tax benefits to them. All of them can be invested into real estate, notes, private equity, and yada, yada. Okay. The way that these plans are taxed, though, might be a little bit different. Okay. And there's 3 categories of plans. And when you look at this slide, what you want to be thinking to yourself is, I want to set up as many plans as possible. Why? Because these plans are treated better as taxpayers than I am as a taxpayer. Because I'm a taxpayer, these aren't. The more money I put into these plans and the more I invest in these plans, the less I have to pay Uncle Sam at the end of the day. Okay? Personal plans would include your traditional IRA and Roth IRA. Most people have traditional IRAs versus Roth IRAs, not because they think traditionals are better than Roths, but if you ever have a 401k, 403b, or have some sort of pre-taxed account at a job that you worked at, that pre-tax money you haven't paid taxes on yet, When you leave that job, that rolls into a traditional IRA. Okay. Pre-tax. The Roth IRA is an after-tax account, meaning the money in the Roth IRA, you've already paid Uncle Sam on that money. So the trade-off is, as you invest a Roth IRA, not only do the investments grow tax deferred, but if you hit 5 years of seasoning with a Roth IRA and you're above the age of 59 and a half, all your distributions out of your Roth IRA are tax-free and penalty-free for life. Okay. Think about that when you apply real estate as an asset class in a Roth IRA. I have a lot of clients that own 12, 15, 20 rental properties in a Roth IRA. When they get to the age of 59 and a half, all they do is sit back and take distributions. Every time one of those renters pays rent to a Roth IRA owned property, they just take it out to themselves tax-free and penalty-free. Uncle Sam can't touch you. You don't need to sell assets. You don't need to sell stocks to live in retirement. You just live tax-free off rental income that's generated by your Roth IRA owned properties. Okay. It's cool to own properties in the traditional too, but the difference is when you take distributions of those same rents out of a traditional, you're taxed. Okay. So I would just say, if you're looking to grow a bucket of money that's small and make it larger, or have cash flow producing properties, you might want to think about opening up a Roth IRA or converting some of your traditional funds to a Roth. And we have a case study that will go over that. And I know Matt loves to talk about backdoor Roth IRAs and Roth conversion. So I do too. So we'll talk a little bit about conversion opportunities here at the end. But personal plans can be self-directed. Your employer plans can be self-directed, which would include your SEP IRAs, your simple IRAs, and even the mighty solo 401k. Not going to spend too much time on these plans, but if you're self-employed, these plans can also be self-directed. You can make larger contributions to these plans, and these plans can also be converted to Roth. Okay. There's some new rule changes actually expanded the option to have SEP Roth IRAs and simple Roth IRAs. So that's coming down the line. And then the plans that nobody talks about, but I love talking about, are the specialty plans, which would include your HSA or your ESA. HSA stands for Health Savings Account. ESA stands for Education Savings Account, or more specifically, Coverdell Education Savings Account. These are not retirement accounts, but these are tax-exempt trusts that you can self-direct. The benefit of these plans is, as you take distributions from these plans, you don't have to wait for retirement to use the money tax-free and penalty-free. You can take distributions out of an HSA to pay for current expenses that are health-related. Qualified health expenses like co-pays, acupuncture, doctor's visits. I paid for my root canal with a tax-free, penalty-free HSA distribution. There's so many things that you can pay for now with your knowledge of an investor and utilizing a plan that can be self-directed to pay for health expenses. And if you have kids under the age of 18, I would highly suggest you look at the Coverdell Education Savings Plan. Okay? It's the only plan for education that can be self-directed, but all the money earned, all the money profit made in a Coverdell Education Savings Account can be withdrawn tax-free and penalty-free to pay for kids' expenses from kindergarten all the way through college. So that would be things like tuition, books, computers, iPads, all sorts of expenses can be paid with tax-free dollars. Switch your mindset as an investor. If you're paying these expenses currently with money in Hip National, I call it, your back pocket, you're paying it the wrong way. That's your most expensive bucket of money because that's your after-tax money. Start thinking about how you can utilize tax-advantaged HSAs and ESAs to find alternative investments, but the profit can be used immediately to pay for today's needs, and then have some investments in your self-directed Roth or 401k for later down the road in retirement. The cool thing about these plans is they can also be partnered together. So as we get into the case studies, what I want you guys to think of is, just because we're saying this case study was done in a traditional IRA or a Roth IRA, most of the investments could have been done with an HSA or an ESA, or even partnered together. I did a loan once where it was partnered with my Roth IRA, my HSA, and my two nieces' Coverdell Education Savings Accounts. Okay, it wasn't multiple loans. It was just one promissory note with fractionalized interest owned by each of my accounts, depending on how much money they put in to the loan. And when the borrower made interest payments back to my IRA or back to the IRA company administrating my IRA, those payments got split pro rata amongst my Roth, my HSA, and my two nieces' Coverdells. But the beautiful part about that is that profit can be used for different things. The Roth money's for my retirement. The HSA, I can use it today if I want to for out-of-pocket health expenses, tax-free. And the ESA profits can be used to help give to my brother to help pay for health or education-related expenses for the kids. Okay. So there's so many cool things that you can do with these plans. And I would just say, remind you, think about all the plans that you can have and all the plans that you qualify for, because if you're not utilizing some of these plans, you might be missing the boat. I always tell people you should have more than one account. Everybody on this planet should have at least a traditional Roth or a traditional in a Coverdale or a traditional HSA, depending on if you've got kids or health expenses. And I'm pretty sure everybody on this program's got health expenses. We'll go over some quick rules and then jump into the case studies. And this is more for the beginners. But as we go over self-directed IRAs, you'll hear this a lot, and you'll hear this term called prohibited transactions. Okay, these are the things that you're not allowed to do when you talk about self-directing your accounts. And the easiest way for me to explain it is just remember your role to your IRA. You're the fiduciary of your IRA. As a fiduciary, your job is to help your IRA grow. Okay? You put money in via contributions. You as the fiduciary need to find investments that are purchased and owned by your IRA. And then you get your benefit when you take distributions. But you have to remember, it's not a bank account. It's not you put money in and you can just take it out to yourself. Once you put money in an IRA, that's the IRA's money. Okay. The IRA is a tax exempt entity, but it's not you. Okay. You're just the fiduciary of that plan. As the fiduciary, you're considered a disqualified person. Okay, what does a disqualified person mean? Well, disqualified persons can't transact with their own IRA. That means if I have a note that I own personally as Nate Hare, I can't sell that note to my IRA. Why? Because I represent both sides of that transaction. That's a conflict of interest. I can't sell my own assets to my own IRA. My IRA has to buy investments from non-disqualified third parties. And we'll talk about who non-disqualified third parties is. But me, as the IRA owner, cannot transact with my own IRA. The things I'm not allowed to do, I can't buy anything from my IRA. I can't sell anything to my IRA. I can't trade assets between myself and my IRA. I can't give a loan to my IRA or take a loan from my IRA. It's different with 401ks. 401ks, you can take a loan, but IRAs, you cannot take a loan from your IRA. And this is important for real estate investors. You cannot extend services to your IRA, i.e., you can't provide sweat equity on your IRA owned investments. Okay. Basic rule of thumb, if your IRA owns the property, find somebody else that does the rehab. You shouldn't be spending that time anyways. You should be enjoying retirement or doing something else. But you can't act as the contractor. You can't do the sweat labor. It's considered an excess contribution. The IRS says, no, we don't want people actively engaging in sweat equity on their IRA-owned property. Okay. The other thing that you're not allowed to do is benefit from the IRA's investment while it's inside the IRA. And what that really means is you can't live in the house. Okay. No, you cannot buy a vacation property and go vacation there. You're not supposed to do that. You can buy a vacation property and rent it out and have all the rents go to the IRA. And then you take distributions of the IRA of those rents to yourself. That's the proper way to do it. But you can't actively use the property for personal use, personal benefit while it's owned by the IRA. Now, I don't want to get into that subject, but we'll talk a little. We'll have another subject where we talk about Roth IRAs and inherited Roth IRAs. I like to talk about how you can actually plan out buying an investment in a Roth and actually live in the property at some point. But just hold that thought. While it's in the IRA, you can't use it for personal use, can't live in it. Okay. The other people that are disqualified to your IRA, and I'm going to simplify this. You guys don't need to memorize this. Disqualified people to an IRA include yourself, your spouse, your kids, your grandkids, and their spouses, and any of your lineal descendants as well. So lineal descendants, lineal ascendants, and spouses. Those are the disqualified people. Brothers, sisters, aunts, uncles, cousins, nieces, nephews. In the IRA world, those are considered family to the side. So they're not disqualified to your IRA. So could my IRA buy a house from my brother? Sure, it can. Do I want to do business with my brother? I don't know that that's something that I want to do. I probably want to keep family and business separate, but I definitely can't buy a house from my son in my IRA or let my son use a property owned by my IRA. Because in definition, you want to think, how is wealth passed? It's usually passed linear. up and down the line. When I die, it goes to my kids. When they die, it goes to their kids. So when you have IRAs and when at death, they become inherited IRAs. If your son was allowed to live in the property, well, then you die and then he's living in the property that is inherited IRA owned. So you just can't do it with those specific family members. And if you ever have questions, just give us a call. We'll help you whether you're a client or not, and we'll kind of walk you through it. We can't give you investment advice or tax advice, but we can at least tell you, no, you can't do that. Definitely can't do that, but maybe you can think about it and do it this way. Okay. Remember, your benefit from your IRAs comes from the distributions. Okay. So let's jump into the case studies, and we're going to start off pretty basic. Okay. We're going to just look at a client that bought a rental property. Okay. And all these are first deals, by the way. These weren't even second deals. I just thought about that. Every case study here is somebody's first deal. So we'll talk about the process real quick. The process is a little bit different than buying stock. Okay. The only thing that's different about buying real estate in an IRA is you just got to work through the process of buying real estate. That's the only hard part, is that buying real estate has moving parts. You've got to deal with agents. You got to deal with title companies. You got to deal with brokers. That stuff doesn't go away just because you use your IRA. But when you're using your IRA to buy property, you have to go through the custodian that manages your IRA. And again, Fidelity won't do this for you, but we will at Directed IRA. So real quick, the steps on any of these investments would be: first, set up and fund your self-directed IRA. Okay. All you got to do is go to our website. We have applications online. It's just $50 to set up an account. And the second step is, once you get the account set up, transfer some money from one of your other IRAs, or you can roll over some funds. If you've got an old 401k, an old 403b, an old TSP, you can roll funds over to a self-directed IRA, typically provided that you have separation of service. You've left that employer, you're not working that job anymore. Once you have the account open and funded, here's where the self-direction part comes in. You find the investment. Okay. And we'll show this in case studies here, but you find the investment. We don't have a bunch of houses to sell you. We don't have a bunch of notes to sell you. Okay. That's your job to self-direct and find the investment. But once you find the investment, you'll work with us, your IRA custodian, where we'll sign off on the purchase agreements. We'll work with the title company if there's a title company involved, or attorney's office, and we'll make sure that the property at the end of the day, or the investment at the end of the day, shows that it's owned by your IRA and not you personally. Okay. So it's a really pretty easy process. Once you get through it once, it's like riding a bike. Open an account, fund an account, find an investment. Let us help you do the rest. So this is a real simple case study, and it's got some lessons in here, though. We had a client, Denise. Okay. Denise set up her self-directed account. She had just transferred jobs, and she was trying to transition into a real estate investor. So she had this 401k, and instead of rolling it over to Fidelity and keeping it there, she wanted to invest it in real estate. And she met us at one of our events, and she decided, I want to invest in real estate. I don't want to invest in stocks. Okay. So she opened a self-directed IRA. We funded it from a rollover from her old 401k. Took about 2 weeks to do that. Once she had it open and funded, she goes out on the hunt for property. Okay. She finds a 4-unit property in her hometown, 5 miles from her house, that she thought was a good deal. Okay. It was in a good time. It was in a good area. The owner of the property, just to give you a little backstory, the owner of the property was kind of just letting properties or getting rid of some of his properties. He was retiring at the time, and he just owned property personally. So he wanted to start living off some of this stuff, and he didn't want to deal with the headaches of all the tenants. So she was getting a pretty good deal on this property. So she thought, this might be a good deal for my IRA. Okay. So the process works is she negotiates the terms just like she would negotiate terms as if she was buying it herself. The only difference is she's going to tell that owner that, hey, it's not my IRA. It's not me that's buying it. It's my IRA. So on the purchase contract, the buyer reads Directed Trust Company, FBO stands for the benefit of Denise Roberts IRA. That's no different than if you ever looked at a stock certificate, if they actually sent it to you from Fidelity, it doesn't say your name on there. If you bought it in your IRA, it says Fidelity Investments, FBO, your name, IRA. So the process is no different. Just replace the word stock, and we're putting in real estate. And we're the company that has to sign off on sign off on the purchase of that investment. We don't tell you it's a good or a bad investment. We just sign it when you send it to us, and you accompany that with what's called our direction of investment form. It's just our internal form that says, hey, Directed Trust Company, I want you guys to buy this house at this address, and this is the amount of money that I have to send to the title company, and give us the contract read and approved. You sign read and approved on the contract, and then we sign as the buyer. Some people say, well, does that mean you guys own the property? No, we're the custodian of your IRA. Your IRA owns the property. Okay. So here's another thing. A lot of people get confused. I hear this every single week. I hear people say, I just talked to my tax advisor, or I just talked to my wealth advisor, and he said that if I do this, if I buy real estate in my IRA, I'm going to have all these taxes and penalties. That's because he doesn't understand what's happening here. All we're doing when Denise opens an account, funds an account, sends us a contract with a direction of investment form, what we're technically doing is we're exchanging her already existing asset of cash, and we're changing that to an asset of real estate. Okay. What your wealth advisor is imagining you doing when you run over to him and say, hey, I'm going to buy real estate with my IRA funds. Can I do that? He's going to go, whoa, 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 put on the brakes, because he thinks your IRA custodian is handing you the money as a distribution, which you would face taxes and maybe penalties. And then you're going to go buy real estate. But that's not what we're doing. This is not a distribution to you. It's an exchange of an asset class from cash to real estate. And then when she sells it, it goes back to an asset of cash. Okay. So money never goes to her hands. We send the money after we get the contract, after we get the instructions from her. We see that the contract says send $5,000 of earnest money to the title company. So that money goes directly from the IRA here, directly to the title company. And on this specific property, her purchase price was $375,000. So she had enough money in the IRA to buy it wholly. I already know some of you are thinking, well, what if I don't have $375,000? Can I still buy a $375,000 property? Yes, you can. Hold that thought. It's coming in a later presentation or later case study. Okay. But in this, it's just an all cash deal. She works with our transaction department. Money doesn't go to her. Money goes directly to the title company. And then when we close on the property, if you looked at the warranty deed, the actual owner reads that same buyer, Directed Trust Company, FBO, Denise Roberts, IRA. Go to your local tax assessor right now and go start looking up titles with FBO. You'll start seeing all the people that own properties currently in your area that own property in their IRA. And they'll even tell you the IRA company there sometimes too. So that's the legal owner here is their IRA, but we're going to be the ones directing, or the client directs us to make the purchase on behalf of their IRA. So on this specific deal, okay, she had $20,000 of repairs that needed to be made. So people always ask, well, what do I do with repairs? How do I account for expenses and rents? Always remember, all of the expenses, all of the profit has to go in and out of the IRA. Again, that's part of our job here at Directed IRA as your custodian. Okay, we handle those transactions as you tell us to pay things. So if we need to pay contractor Bob for $20,000 to fix the property up, you just send us a payment authorization. These are all forms that you find on our website. Give us a copy of the invoice. We send money directly to contractor Bob out of your IRA. We don't give it to you. Okay. Once you have rents that are coming in, the rents need to come to the IRA in most cases. Okay. So in this case, since this is 4 units, here's something you want to think about. And here's what she did. She just hires a property manager. Okay. The property manager oversees the units. The property manager makes sure that the units are rented. She doesn't do any of that. She's just quarterbacking the deal. Okay. The property manager pays the expenses, collects the rent. That way, when there's money left over, the net amount, she can tell the property manager to send the net amount to Directed IRA. And that just goes right into your IRA as profit. Some people say, well, what if that exceeds my contribution amount? Profit is not contribution. Contribution is what you take out of your pocket and put in on an annual basis. We're talking about profit. Profit's unlimited. You can have as much profit as you want. Okay. So rents, appreciation, that's all considered profit. So on this specific deal, remember, this was an all cash deal. There's no loan payment or anything like that. Her 4 units were all rented, and it was netting her about $4,200 a month. Okay. For the next 24 months, just that amount, just on the rents. Okay. Is a 10.63% rate of return. Okay, annual rate of return. How many people would take 10.63%? I'd take 10% all day. If I can make 10% every year in my IRA, I'd have a pretty healthy IRA. Okay, think about all the people that lost so much money in the stock market. You think they want to go back and invest in something like this and make 10% just on the rents? So Again, and all these rents are not taxed. Okay. She can reinvest those rents if she wanted to, or leave some money in the account for some unanticipated repairs or something like that. Or she can move some of that rental income and move it back to Fidelity if she wants to put it in the stock market again. Again, you can just move money back and forth between IRAs, and it's not a taxable event as long as you're moving it from custodian to custodian. Okay. Now you're asking, well, what about the appreciation? Okay. She did actually sell this property and she sold it 2 years later. So let's look at the final numbers for Denise and see how she did. She sold the property 2 years later, same process in reverse. She negotiates a term with the buyer. She draws up a purchase contract. The seller is Directed Trust Company, FBO, her name and account number, her name and IRA. She sends that to us. We sign the sales agreement. We work with the title company. All the proceeds come back to us, and it's redeposited into her account completely exempt of taxes. So after closing costs and holding costs, she netted about $172,000, which for her annualized for 2 years was a rate of return of 21.89%. I think Denise did pretty good considering this was her first deal. She obviously she would work through with the transaction department. Our transaction department is very, very good at helping walk people through the process. We make it very easy for clients. Just go look at our Google reviews. We made this process easy. I will tell you though, it's not easy the first time all the time. Sometimes you hit some speed bumps, and sometimes we got to remind you that, hey, you're not supposed to sign the contract, and you give us a contract that you haven't signed. But once you do this once, it's like riding a bike. Okay. How would you have made this investment better? Well, I would say that being that it's 21.8% on an annual basis, I'd rather have that amount tax-free, not taxable. And what I mean by that is when she did this investment, remember a 401k, if it's pre-tax, rolls into a traditional IRA. So this investment was bought, owned, and sold in a traditional IRA. She still did good. It's still 21%. But when she starts taking distributions in retirement, that profit's going to be taxable to her as a taxpayer. Okay. If she had converted the money first and then bought it in the Roth IRA, well, then all that profit would have been tax-free. And that's what we're going to look at on the next slide, which is a client that actually did this. And we'll talk about going from forever taxed to never taxed. So Jim is another investor, and Jim actually was a full-time real estate investor. Okay. The moral of that story is he was pretty good at identifying what a good deal was and what a bad deal was. Okay. So if you're a real estate investor, if you're not investing in real estate, I would ask, why not? That's what you understand. So Jim understood real estate. Jim just found out that he can move his old IRA, rollover IRA to directed IRA and start investing in real estate. And he found a deal almost right away. Now, here's how he found this deal. I'll give you a little backstory. He was a flipper. He had flipped 3 or 4 properties in this kind of same area of his town. So he was out in the yard taking one of the signs down of a property that he had just sold, and the neighbor comes out from across the street. He says, "Hey, I noticed that you had, your sign up for the last 2 years. I assume you're a real estate investor." He said, "Yes." He said, "Hey, I've got a little bit of an issue." He said, "I was supposed to close on this house. The buyer fell out of escrow. The problem is I am relocating to North Dakota. I've got a new job there. I'm supposed to close on my house there. My family's already there. I'm just here to try with the closing." And there were 2 weeks prior to this property having to be closed. So this guy was a motivated seller for sure. So when they negotiated the terms, Jim knew this is going to be a good deal. I'm getting this below market value. Right then, if you know below market value, you should be thinking, I want to do this in a Roth IRA. And this is exactly what Jim decided to do. So Jim decided, I want to pay taxes on my traditional IRA that I just rolled over to directed. Okay. Or you can convert it at Fidelity, doesn't matter. Okay. But I want to convert this to a Roth first. I want to pay the taxes, rip the Band-Aid off first, and have all the profit that I can realize on this property, because he assumed he would have profit, and make that completely tax-free. So Jim does 2 things. He fills out a Roth conversion form. If he converts it with us, if he converts it with Fidelity, he can fill their Roth conversion form out. What happens when you do a Roth conversion is we're just going to send a 1099, okay, at the end of the year based on your conversion amount. Okay, you don't pay taxes out of the conversion. You don't pay taxes the day you did the conversion. So the important part about that, especially when you think about conversions done right now, is conversions, if you did a conversion today from traditional to Roth IRA, you don't have to pay the taxes until next April. Okay? That gives you a lot of time to prepare for the taxes. So when Jim did this deal, he did the conversion in January, which is actually a great time to do a conversion because you have 16 months to prepare for the taxes. Okay. So what he did is he converted his entire traditional IRA to a Roth IRA of $200,000. He knows he's got that tax liability coming down the road. We'll just assume, because I didn't do his taxes, but we'll just assume that Jim has to pay 28% on that additional $200,000. Okay. Blended rate. Okay. That's about $56,000 that he's going to pay the following April out of his own pocket. Okay. But now he has $200,000 in a Roth IRA versus a traditional IRA. And when he makes an offer on the property, his buyer on that contract says directed IRA or directed trust company, FBO, Jim's Roth IRA. Okay. So Jim does the whole same process. We sign the contract. He sends us a direction of investment form. We close on the property in the Roth IRA. And this was a flip deal. Okay. There was very little rehab that he had to do on this property. Basically, all the profit was the fact that he got it below market value. Okay. So he bought it for $170,000 in the Roth IRA. Okay. Rehab was only about $10,000. And I think that's generous. I think that's rounding up. Okay. He rehabbed it, sold it for about the same price that he sold his other flips for, was $254,000. Gave him a net profit of $65,000, which was a 36% cash on cash return in 6 months. If you annualize that out, that's 72%. I want to go back here for a second. See his profit, $65,000. It's all tax free. Here's the cool thing with Roth conversions that you want to look at when you're doing things like real estate. If you're going to do on the first deal, if you're going to make enough profit that pays for the taxes, everything beyond that point is all ching, 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 ching. Okay. He basically made up the taxation on the very first deal. Now, some people say, well, did he take the money out of the Roth IRA to pay the taxes? No, I would probably advise you not to do that. You want to leave all that capital in the Roth growing on top of itself and just pay the cash out of your pocket. And further along in the story, he was able to flip 2 or 3 more properties over the next 2 years. And now his Roth IRA is valued at about $600,000. So do you think Jim's glad that he paid taxes on 170 versus the 600 it is now? That's the power of the Roth IRA. Had he kept that in the traditional IRA, he would have done the same exact investments, but he would have had $600,000 of taxable money, not tax-free money. Okay. So that's a benefit with a Roth IRA. I'll do a class on this if you guys want. If you guys want me to expand on Roth IRA, I like to talk about the different ways that you can strategize Roth conversions and actually talk about some of the considerations. You want to consider, well, how much is it going to cost me? Do I have enough to pay the taxes? What's my impression of taxes in the future? Am I going to be in a lower tax bracket this year or a higher tax bracket next year? That could play a part in your decision to do a conversion in different years. And you don't have to convert your entire IRA. You can space it out and do. I know a lot of clients that convert a little bit each year based on their marginal tax bracket in given years. I think the biggest thing you want to look at, though, is just what's the investment? The investment should make the ultimate determining factor of whether you convert or not. You shouldn't just convert a bunch of money without knowing what you're investing in, because some advisors will tell you not to do a conversion, and they might be absolutely right because your investment with them might be like a CD. Well, CDs make a little bit more money now, but there was years that they were making less than 1%. Would it be a smart idea for me to convert $200,000 from traditional or Roth to get 1% tax-free return? No, I'll never see the break-even point. I'll be dead before I even make up the taxes that I had to pay. But Jim made up the taxes on the very first deal, and he did it in 6 months. So that's the ultimate thing that trumps everything when you think about converting is what's the investment going to be? Okay? And the other thing is inherited Roth IRAs are probably one of the coolest things that you can leave somebody, okay, on earth. I want to do this one. I know, Tristan, I'm running long on time, but I got to go through this one because I know people wanted to do this, okay? But I only have a small IRA. Can I still buy real estate? Okay, yes, you can. The answer is yes, okay? Because IRAs can use leverage, okay? There's a lot of different leverage you can use. You can use the leverage of money in the form of financing. IRAs can get loans, and I'll do a presentation that will go specifically over those strategies as well. And I'll even give you a list of IRA lenders. If you guys are interested in that, just let us know in the chat. But there are banks that have IRA loans. They'll loan your IRA money as long as your IRA can come up with about 30 or 40% down. Okay. Those are institutions that loan to IRAs, but you have other opportunities where I've seen IRAs loan to other IRAs in the form of financing, where one IRA owns a property using a down payment and another IRA owns the note on the property. Wow, what a phenomenal way to grow 2 IRAs at the same time. Okay. The other thing that you have in your court is you have time. A lot of times, depending on your age, you've got time to build these investments up. So what I would say is don't pass on good deals just because they don't make money tomorrow. If it's an investment that makes money or that doesn't make money tomorrow, but if it makes money in 10 or 20 years, well, maybe it's a good investment to put on the shelf and put in your Roth IRA, for example. The other thing you can leverage is your own experience or the experience of others. And this is what Ryan did in his investment. He leveraged his own experience. He leveraged other people's money, and he leveraged a creative investment strategy, which most people are familiar with, which is just seller financing. Okay. So Ryan started with a $6,000 Roth IRA. That's it. Okay. He asked me one day, he said, "Hey, what should I do with $6,000? It's kind of hard to buy a house with $6,000. Should I just wholesale or do something like that?" I said, "Well, you can flip contracts. I mean, that's fine. I would be cautious of flipping too many contracts because it could be problematic for your IRA. We'll talk about that on a later program." So he went back to the drawing board. And the next thing I know is Ryan's telling me about this deal that he did. And I just think it's a phenomenal deal that I always like to talk about. So while Ryan was out looking for properties, and he was looking for properties not only for his IRA, but for himself, he found this situation. Okay. A widow just inherited 3 warehouse units because her husband just passed away. Her husband was the real estate investor. Her husband was the property manager. Her husband managed all this. She was not a part of these properties at all. But when he died, that problem became her problem. Okay. She didn't have a property manager in place. She tried to manage with the tenants. She tried to get the tenants, work with them. But once he died, it became problematic for her to deal with these tenants. And she just was not in the right state of mind to deal with these tenants. Out of the 3 warehouse units, only 2 were rented. Okay. So she was getting rents periodically. She wasn't even getting rent on all 3 units. And one of the tenants stopped paying her on a consistent basis. So by the time Ryan talked to her, she was kind of in a predicament where she just said, I don't want to deal with the property anymore. I don't need the money. I just don't want to deal with these tenants. Okay. Ryan had time to deal with the tenants. Okay. So he went back to the drawing board and he started thinking of something. He thought, well, what do you really want from this deal? And she said, I just want the income. I like to have the monthly income. I don't need a large sum of money. I've already got savings. I got some stuff from my husband. I would just like to have the income without the headache. Okay. So Ryan had an idea. Ryan said, what if I gave you $6,000 from my Roth IRA as a down payment if you would carry back a note to my IRA? Okay. She said, okay, how's that work? Well, basically you own it cash. So I'll give you the down payment of $6,000. We'll still close at a title company. We'll have an attorney draft a promissory note where my Roth IRA is the borrower. Okay. And my Roth IRA will make monthly payments to you that are about the equivalent of what you would have been getting if all 3 warehouse units were rented. She said, that sounds like a fair plan. Okay. So he made the interest payments on the note similar to what she would have been getting with the two renters and a little bit more. So that made her happy. And this way, Ryan's Roth IRA was able to own a property worth about $150,000. Okay. But he bought it for $100,000 with a seller carryback note of $94,000. Okay. And now he's got to make payments to her, to the previous owner. So how does he do that? Well, immediately after taking ownership of the property in the Roth IRA and processing that through the IRA company, okay, what he did is he got his property manager to find another tenant for the 3rd unit. Okay, got the 2nd tenant who was paying infrequently to pay frequently. Okay, the property managers can now collecting rent on all 3 units. Okay, doesn't have much expenses. I think they didn't even have any rehab. They just had to cut a tree down, is what he said. But he's got all this rental income. The rental income goes where? Back to the IRA company. What's Ryan do with the rental income that's sitting in there? Makes payments to the previous owner. So he keeps this process going. Rent the property, rents go to the Roth IRA. Roth IRA pays the note payment, and he keeps this cycle going for about 16 months. Okay. So 16 months later, one of the tenants comes to Ryan and says, hey, I'd like to own my unit. I'm tired of paying rent. I want to own it. Okay. So, okay, that's fine. What do you want to pay for it? He said, I'll pay you $95,000 for it. Okay. Cash. Ryan said, okay, that's a pretty good deal. So Ryan agrees to that. And if you guys see where this good story is going, that $95,000 was pretty much the amount of the note. So with this holding this property for 16 months, Ryan was able to hold it long enough to where one of the tenants bought one of the units, okay, gave him enough cash to pay off the previous owner. Okay. He made an additional contribution to account for some closing costs and things like that over the next 2 years. But now what Ryan owns in his Roth IRA is 2 cash flowing free and clear warehouse units that generate rent. And he's in his 30s. Okay. This is a great investment, and it shows you how somebody can take a small amount of money, use a creative strategy like seller financing, and take down a property with very, very small amount. Now, some of you IRA nerds out there might be saying, well, doesn't his IRA have to pay UBIT or UDFI? Yes, we'll talk about that on a later program. When your IRA has debt leveraged property, just as a quick note, your IRA doesn't get to keep all 100% of the profit completely tax-free. Okay. It can keep a portion of the investment or the income tax-free. Whatever it borrowed or whatever the debt leverage percentage is, he has to split that piece with Uncle Sam. Okay. Doesn't make the investment bad. It just means that when he sold the property, when he sold that unit, he had to pay a little bit of tax on the capital gains of that unit. And he had to pay a little bit of tax on the rental income he generated from the rents over the first 16 months. But once he sold the property and then there's no debt on the property, how much tax does he have to pay? 0, because there's no more debt on the property. So from that time on, after 16 months, everything is completely tax-free. And even that very small amount, which I think was about $9,000 he had to pay in tax, which wasn't very much at all. If he had done this in a 401k, there's actually an exemption to that rule where you don't even have to pay the tax. So this is a great investment. It shows you, it doesn't matter how young you are, doesn't matter how old you are. You could have been 70 years old and done this deal and turned 6,000 to 200,000. That's what I love when clients say, I think I'm too old for a Roth IRA. No, you're not. Just look at what Ryan did. He did this in 16 months, took $6,000 and made it into $200,000. And he's done other investments past that point. So I don't have time to go over this case study, but I'll do this on a later program. It just talks about a client that bought land and actually borrowed money. It's the same concept. It's just that you're not the owner's not financing it through seller financing. He's just going to a bank and getting financing to help buy the property. But I'll save that for another day. Kristen, do we have questions on any of this so far?
We do have a few questions. I think we have time for 1 or 2.
Okay.
Let's see here. All right. Richard's asking a little bit of a good question here.
Fire away.
In an SDIRA, why does a purchase need to go through the custodian? He has an SDIRA where he manages the IRA as an LLC.
Okay.
If I manage the LLC, can't I work the deal without going through the custodian?
You can. So that's one way that we didn't go over. And I think I had a slide here, but I didn't have time to go over it. There's different ways that you can work through your custodian. Now, just to answer that question, you did work through a custodian. You just worked through it by basically rolling your IRA to them first. And then what he did is he set up an LLC that he manages. Okay. This is what we do at the Directed IRA. We can set up what's called an IRA owned LLC. Okay. You set up an LLC, you manage the LLC. And what we do is we make an investment and buy ownership of that LLC. Okay. It's still an investment on our books. You still have to work through Directed IRA. It's just your investment is not real estate. Your investment is 100% ownership of an LLC, or it could be joint ownership of an LLC if you used other accounts. Now, from that point, now your LLC goes out and actually takes title to property. When you dissolve that LLC, all that money needs to come back to the IRA. So it's really the same process. The only thing that's different is you're just throwing an entity in the middle there. And it could be an LLC, it could be a trust, it could be all sorts of different types of entities, but it's a good way to do that. I would suggest before you set up that structure, talk to somebody at Directed IRA, make sure that that's a viable option for you. I would say not everybody needs that structure. If you're just buying one property, okay, you probably don't need an LLC to do that. Okay, I'm not giving you tax or structuring advice. I'm just saying, if you're not going to be very active and you don't have a lot of moving parts with that investment, what do you need the LLC for? LLCs are usually, do you need quick access to the money? Do you have a lot of moving parts? Are you going to buy a lot of investments? It can save you in transaction fees, even though our transaction fees are low, but it's the ease of use that the LLC gives you if you're going to be very, very active and buy multiple properties. So I hope that answered your question there.
All right. One more from Cindy. She is a full-time real estate investor. Her company spends money on marketing. If she buys a house that came from one of those leads generated from the marketing, would that create a prohibited transaction?
That's a tough question. So first, if you do, I wouldn't tell anybody. And here's what she's getting at is that when you talk about prohibited transactions, you got to be careful on what type of services you're extending to your IRA. Okay. Are you extending services to your IRA, or are you just finding investments as the fiduciary? You're kind of in a predicament there because you have to find investments for it. That's your job as the fiduciary. If it so happens that it comes through your marketing, efforts because you're a full-time real estate investor, is that prohibited? I wouldn't say it's low-hanging fruit for any IRS agent. In a perfect world, you probably want to find, investments outside of what your marketing tactics are doing. But again, you can always make the argument that you have to find investments for it. Okay. As long as you're not taking some sort of personal benefit from it, from the IRA's investment, I think you're okay there. But you just want to be careful. If you can separate what you do in your IRA from your business completely, but if it just so happens that this property that you found through your marketing stuff made sense in your IRA, I don't think that that's really going to cause a problem for you. I mean, that's basically what Ryan did. Ryan was a commercial real estate broker. He was on the hunt for properties. He was out there. I mean, can you make the argument that he paid for gas to find it? I mean, no one's going to really come down your throat for that, I think. But just be cautious and try to separate that stuff out as much as you can.
All right. Last question here. Kurt asks, how did the 5-year rule play into paying the owner monthly for the loan on the warehouse? Assuming he's talking about the Ryan deal.
Yep. So how did repeat that one more time?
How did the 5-year rule play into paying the owner monthly for the loan on the warehouse?
Okay. So I think I see where he's going with that. So I think based on your question, I think what you're assuming is those payments are distributions. Okay. Payments out of your IRA to pay for an asset related expense are not a distribution. So as money's coming in and he's just paying an expense, which is the loan payment, there's no 5-year rule applied to that. And what he means by the 5-year rule is there's a 5-year rule on Roth IRAs where you can take tax-free, penalty-free distributions to yourself. Okay. Once you have the IRA open for 5 tax years and you're above the age of 59 and a half, distributions to yourself are tax-free and penalty-free. The 5-year rule doesn't apply to paying expenses, just on taking distributions to yourself. Good question though. Anything else?
That's it.
All right. We're good, guys. Hey, do me a favor. We ran a little late and I apologize. And we've got a ton of stuff that we want to go over. Tell us in the chat what you want me to expand on. Do you want me to go over, would you rather want to go over Roth conversion strategies? Do you want to go over more buying property with small amounts of money? Give us some ideas because we're flexible in this content and we want to make this as much for you guys as it is for us. Our whole goal here at Directed IRA is to help you become better educated investors. And we do have some great investors that are actually going to come on some of these programs with me. So I'll just give you an idea. We have a gentleman by the name of Jason Bible. If you guys are familiar with Jason Bible, Mr. Texas Real Estate, very, very phenomenally smart real estate investor out of the state of Texas. He's going to be on with me on the next program talking about how to identify a good real estate market. This is good for you guys. Register for that if you want to invest out of state. Okay. I know some people don't like to invest in their own state because properties might be too expensive. Well, there's a whole, thing with due diligence and understanding different markets. When you start investing outside of your state, it's probably a good episode that you want to join in on because he's very, very good at going over the dynamics of a real estate market, all the economics with the real estate market. Very, 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 very cool episode. So make sure you guys register for that. And then on the 17th of May, we actually have my friend Jason Matthews, who's going to be on. He's an investor out of Florida that does Airbnbs and short-term rentals. So that's another cool topic that we're going to dive into is, can you buy short-term rentals and Airbnbs in an IRA? Oh, yes, you can. There are some cautions there, though. You might incur some taxation, but we're going to talk a little bit about that. I've seen some great investments with Airbnbs in a self-directed IRA or Roth IRA or whatnot. If you guys are yearning for more education too, go subscribe to our YouTube channels. We've got a YouTube channel with Matt Sorensen. We've got our own YouTube channel that we're launching here soon. You can scan that QR code. We also have a lot of content on our website if you guys want to join there. And then you can also email me. If you guys have questions, email me. My email is nate.hare@directedira.com or go to our website and you can find in our, you can book a call with me if you want to book a call. I love to talk this stuff. So if you guys want to analyze different investment strategies, go ahead and set an appointment with me. And I do want to mention that we do have a special promo for anybody that is either a current client that wants to open maybe more accounts. Maybe you're intrigued by this Roth IRA and you want to do some conversions, or maybe you just hearing about this stuff and you want to start a self-directed account and start buying some real estate or some notes or other alternative assets. We got a special promo code for joining in on our workshop. So anybody that joins in a workshop, we give you $100 off your first year's fees. All you have to do is use the coupon code RYR. It stands for Rethinking Your Retirement 100, and we'll give you $100 off your first year's fees. And that's for every account you establish. So you want to set up a Roth, a SEP, a couple Coverdales, and an HSA, you get $100 off every one of those accounts. And our fees are so low, that's almost like 30%, 50% of your first year's annual fees. So make sure you guys use that code. Make sure you reach out to us. Let us know what content you want us to expand on or do more of. And I hope that you guys go to our workshop page on our website and register for the next workshops there. So I'm signing off. Nate here with Directed IRA. We'll see you guys next time.
Three, two, one.